Hi, I'm Eric Roston, a climate reporter here at Bloomberg Green, and welcoming you back to our Bloomberg Green Summit, where it's my great pleasure to introduce to you Robert Litterman, who has had a legendary and distinguished career at Goldman Sachs. And in the years since he left that post, he's been working extremely hard, producing some extremely creative and productive ideas on how the financial community can help fight climate change. Bob, welcome.
Thank you, Eric. It's a pleasure to be here.
Now, you really made some headlines last year in the fall because you were the head of a unique CFTC commission looking at the financial risk of climate change. Can you tell us a little bit about that work, how it got started, and what some of the conclusions were?
Yeah, no, it was a great report that we put together last fall, and it started with the CFTC Commissioner Russ Benham, who is the sponsor of the Market Risk Advisory Committee. They had some hearings in his advisory committee about climate, and decided that they wanted to create a subcommittee and write a report. I think it was quite unusual to see this coming out of the CFTC. You know, the Fed, the SEC, the FSOC, you might think, would be focusing on this, but instead it was the CFTC that really took a leadership position. And I give Commissioner Benham a lot of credit for that. He brought together, there were 34 of us on the subcommittee, ranging from banks and insurance companies, corporations like oil companies, ag companies, as well as academics and NGOs. And he gave us a very broad assignment and asked us to, reach consensus. So we got together. We spent, the better part of a year forming various work streams, and those eventually led to the chapters in the report. And we were able to create consensus, which in itself, I think, made the report more powerful. Because, it's one thing if we all agree on a lot of things, but no one knows that we all agree. But it's another thing entirely when we write a report and we say, here are in this case, 53 specific recommendations that we all agree on. And since the report was published last September 8th, I guess it was, there's been just an incredible amount of forward progress on this. The Fed, for instance, has joined the NGFS. The SEC has asked
What
for.
is the NGFS for
Oh,
folks
sure.
at home?
Well, it's a group of central banks around the world and other financial regulators that are getting together to create a common approach to addressing climate risk. It's called the Network for Greening the Financial System, and the U.S. was really the last major central bank to join, and it's good that they did. That was one of the recommendations of the report. And a theme of the report was that the U.S. has to join the international regulatory community. And we see that the European central banks and the NGFS have been leading the way on addressing climate risk among financial regulators globally. And it's good to see the U.S. joining that. I was going to mention that the SEC has asked for input about disclosure of climate-related risks. The CFTC has started moving on its own to regulate climate-related risks in the derivative markets. The New York banking regulator has asked for input from banks and insurance companies that it regulates. So there's a lot of motion. And just a couple of weeks ago, the FSOC, the Financial Stability Oversight Council, which is chaired by Treasury Secretary Janet Yellen, had its first meeting of the new administration, and you could just see all the members of the FSOC, which includes most of the financial regulators in the U.S., all saying that they're going to start moving in this direction. So it was very gratifying to see that, and it's gratifying more generally to see this new administration taking an all-of-government approach to climate risk.
We've seen a lot of calls over the years for a lot of climate action, for whether it's changing our automotive fleet so we don't have to use oil, to shutting down coal plants, Like we haven't seen activists on the street clamoring for regulation from the Commodities Futures Trading Commission. Um, what are the things that prompted them to take this more seriously? And what are some of the specific recommendations that you came out with to address those growing real world concerns?
Sure. Well, I think what led the CFTC to take this seriously was just the realization that all of the financial regulators, not just in the US, but globally, have a responsibility to make sure that corporations that they regulate are disclosing material climate related risks. And when we started this subcommittee and started talking about it, it became very clear that first of all, everyone pretty much agrees on that. So there wasn't a lot of pushback from anyone on the committee. What became clear, though, was that it's not entirely clear to anyone how to define a material climate related risk. Okay, we know that we have to report them, but what makes them material? Is it in the eyes of the beholder? And that makes it kind of difficult because no one wants to push the frontier about where we're going, and so that's one of those
Well, what's
things
your
that
best
we really.
guidance? Sorry.
Well, what the subcommittee said, and I agree with this, is that we need cooperation between the regulators and the private sector, and that it probably makes sense to do that on a basically industry by industry basis, because the disclosures that are going to be required from the oil and gas industry, for example, are going to be very different than those required from cement or steel or tech or someone else. So there may be many companies for which there's really no material climate related risks, and then other companies where it's a very serious risk, especially going forward in the next longer period of time. So one of the differences between let's say traditional financial risks and climate related risks is the time horizon. We typically think about scenarios and stress testing of regulated financial corporations and companies in terms of the next short period of time, whether it's a crisis or maybe a business cycle. So somewhere between 3 months and maybe 5 years at the outside. And clearly, that's not enough time for climate risks to play themselves out. So when you're thinking about climate risks, it's not so much do you have the capital to withstand the next downturn, it's rather do you have a business plan that makes sense given the rapid transition that the whole economy is going to have to make to a net zero economy over the next, say, 3 decades.
You emphasized that this was really a consensus document and that a broad range of stakeholders really shook hands on issues that they hadn't considered together before. Like, can you give us a sense of who is in that coalition? Who are some of these disparate voices that helped you reach the conclusions of the report?
Sure. Well, it was a very interesting group, and as I mentioned, you had the major banks and insurance companies. You also had investors and asset owners. I think I neglected to mention that, and especially the asset owners and investors have a very strong interest in getting the information that they need to understand the climate-related risks in their portfolios. So they were major advocates for disclosure. And again, no one was pushing back really to say we shouldn't have disclosure, but the issues are, what to disclose and how do we figure that out? What scenarios do we look at? So we had a whole chapter, for instance, on scenarios. There was a lot of input on that chapter from NGOs, from academics, and also from investors and asset owners, but also from corporations. So I would say kind of trying to pin down the various, and we had a number of recommendations associated with disclosure, was where some of the more difficult consensus building was required. And I would say, in terms of the consensus building, we had a lot of input from the NGOs in particular, some of the academics, and we had to get down into the weeds really and negotiate specific language. But in the end, that was language that everyone could support. So That and all the other 52 other or whatever, 53 recommendations in total. I would say, look, one of the recommendations, in fact, recommendation number one, which the committee agreed was the most important and urgent recommendation, had to do with pricing risk, pricing climate risk in particular. And the fact is that, governments around the world, but in particular here in the United States, are not creating appropriate incentives to reduce emissions. And the participants in the financial sector, in particular, understand and observe every day how important incentives are. I mean, capital flows in the directions of expectations of being able to make profits. That's where investments flow. And those are expectations conditional on the incentives that all of us face. Those are incentives that are created by governments with respect to reducing emissions. So right now, we don't have those incentives. I mean, when I look around at incentives, I like that word rather than taxes because it's more broad. There's incentives that are created by subsidies as well as taxes. There's things like gasoline taxes that were not designed to reduce emissions. But in fact, when we look across all of the spectrum of incentives, which go in both directions in this country and elsewhere, the biggest incentive to reduce emissions actually is created by gasoline taxes in this country and more generally fossil fuel taxes around the world that most of the time were not created to reduce emissions and are too low. But I would also say that when we look globally at the different incentives on a comprehensive basis, there is quite a dispersion of incentives. So Europe, in particular, we see, for instance, France has incentives to reduce emissions that are over $100 a ton. Only, a small part of which are coming from their emissions trading system, which is their carbon tax. In the U.S., we have gasoline taxes, as I mentioned. We also have incentives to support renewable energy. We also have, various subsidies to fossil fuel as well. And when you add them all up, we estimate at my firm, Kepos Capital, we have something we call a carbon barometer. We estimate that the total incentive to reduce emissions in this country is on the order of $18 a ton. And that's just much, much too low. So we've got to get those strong incentives globally. And the other thing you notice when you look is that countries that have strong incentives to reduce emissions have a less carbon intensive economy. Again, primarily in Europe right now. And countries like the US, like China, like India, that do not have strong incentives to reduce emissions have a much more carbon intensive economy. And then you have some countries like, I don't know, Venezuela, Iran, and Saudi Arabia, some of the Middle Eastern countries that have actually net incentives subsidizing fossil fuel production, and they have very carbon intensive economies, and they're getting worse over time. So
What
there's no
you've been a
question.
champion. I'm sorry. You've been a champion of carbon incentives, I guess we can call them, in Washington for a number of years. What's your reading now on the new administration, the appetite, either in the administration or in Congress, for some kind of carbon pricing?
Yeah,
How can
yeah,
ideas become policy?
it's very sad because everyone knows that we need incentives and how important incentives are. That's what changes behavior. That's what incentives are. Anything that changes behavior. We don't have them adequately in this country, and that's why we're producing too much emissions. Now, everyone from the World Wildlife Fund to ExxonMobil has been supportive of the Climate Leadership Council. I'm the co-chair there with Catherine Murdoch. We have a bipartisan approach to pricing emissions, and the sad thing is we can't get any support from our friends on the Republican side of the aisle for this. And so it doesn't surprise me that the Biden administration is going to do what they have to do, and they're going to do it on a partisan basis because they can't get a bipartisan support, which is really, really sad. And I haven't given up on that. The Climate Leadership Council, we're still trying, but the train is leaving the station on reconciliation. And if
You
these
need budget
Republicans don't
reconciliation.
budget reconciliation, and there may
Congress.
be incentives to reduce emissions in that. But, that would, in my mind, be kind of sad because it would be nice to have a bipartisan approach. Again, I don't know where these Republicans are on climate. They're certainly not supporting market based approaches. And we've got support for that now from all of the major corporate interest groups, whether it's the Chamber of Commerce, the National Association of Manufacturers, even the American Petroleum Institute, is supporting a market-based approach. So I don't know why we can't find Republicans, but I don't blame this administration for saying, look, we're going to go ahead one way or the other. If we can get bipartisan support, great. Otherwise, we're going to do it on our own. And I applaud that.
You've been publishing the last few years in the research literature, as well as the public press, about carbon pricing and what a reasonable number is to affix to every ton of carbon dioxide emissions. What's that research led you to conclude about a US carbon price, whatever policy vehicle it rides in on?
We need to move urgently and we need to brake hard, is what I say. When I say brake, I mean we need incentives to reduce emissions and we need strong incentives. The best way to think about this, which is really a pretty simple way, I won't claim any originality here, but we're going to have to use all the tools that we have. And that means everything up to and including direct air capture at some point down the road. That's going to have to be at scale, reducing pulling CO2 out of the atmosphere. At the same time, when we get to net zero, we're going to have carbon dioxide still going into the atmosphere. We're going to have to pull that out at the same level, and that's going to be expensive. And so the right incentive today to reduce emissions is basically what it's going to cost to clean up the problem in the future, and that's it, no one knows. But direct air capture today probably costs $250 a ton, something on that order. Maybe 20 years from now, it'll be down to somewhere between $100 and $150 a ton. But it's a lot of money, and no one knows for sure. So we can't sit around and hope that it gets cheap in the future to clean up the mess we're making. We have to plan for worst case scenarios, and that's worst case in terms of the cost of cleanup as well. Bottom line is we should be creating those strong incentives right away to reduce emissions and hopefully get to net zero soon enough to avoid the worst possible scenarios from climate change.
So it sounds like the de facto US carbon price as it is now is a factor of 10 or 20 less than it needs to be.
Well, it could be 10. Yeah. I mean, if you think of it as being about $18 today, I would say, it might not be 10 times, but it's on that order of magnitude for sure.
Mhm. So you are the chief risk officer at Kepos Capital, which is where you've hung your hat for several years now. From that perspective, from an investor perspective, what have you learned? What kind of tools do you have now for low carbon investing that weren't available a few years ago?
Sure. Well, going back many years ago, I was saying you've got to avoid stranded assets as an investor, and coal, tar sands, oil and gas, and that has been a winning strategy for many, many years now. And we did something at the World Wildlife Fund that was very successful in terms of hedging those risks. Today, though, I think the stranded asset idea is an old idea, and it's played out. It's hard to worry about coal because there's hardly any valuation in coal. I mean, maybe there's a few $1 billion there. Look at Tesla. Now 600 billion or something, 700 billion. Uh, you know, it's just orders of magnitude more important to get it right in terms of the opportunities to take advantage of the rapid transition to a low carbon economy. So I would say where my firm is and where I am as an investor is looking at the opportunity side of the equation now. And that's opportunities in terms of the low carbon sectors of the economy, also the low carbon companies within each sector. And then I would also point investors to carbon allowances, in the EU, in California, in RGGI, and in a number of other places, venues around the world. These are also, in many cases, rapidly appreciating. Look at the EU ETS prices over the last couple of years. It's been a real good investment.